Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom today. It's my co-host, Michaela Dowdy. Hey, Michaela.
Hi, Casey.
So before we get started, today we're going to talk about 5 common financial myths. And these myths are, I'm excited about these. These are not something we just found on the internet, right? These are 5 myths that we have kind of uncovered in our financial planning.
Yes, they're the ones we're seeing day to day through all of our clients here lately.
So before we get started, though, there's a bonus feature here. Actually, it's kind of sad. This made me very angry when I went through this article. It was published back on July 20th by CNBC, referring to a former now Morgan Stanley broker that stole over $7 million from his clients. And it was pretty close to home. I'm in Wilmington, North Carolina, right? Just a very sad situation. And this is like the public service announcement, I guess, of this. You never, before I get in, I'll tell his story, but before we get into that, just remember one thing. You never write a check to your financial advisor or to the firm of the financial advisor. If you're an independent like us, you would never write a check to Wiser Wealth Management ever, unless you're paying for like hourly financial planning or something like that, but never an investment check ever. So basically what he did over several years is he convinced clients to leverage their portfolio. So they through a Morgan Stanley product, allows you to borrow money against your brokerage account, hand him the money personally. So didn't write it to an entity, no audit trails, no nothing. Hand it to him personally. He would invest the money in different things. And there were no checks and balances. I think he probably preyed on the people that were the least educated about investing, but basically just went and spent all the money. And only was found out, not by Morgan Stanley. Morgan Stanley had no clue this was going on. They're in charge of the oversight of the broker. They had no clue this was going on. And in the end, a client had turned him in and said, hey, something's not right here. And they profile in the article, a young lady, single mom, $1.7 million in liquid assets. And basically he took it to zero.
Just heartbreaking.
It is. And I tell people all the time, I said, the barrier to entry to be a financial advisor is very, very low. Anybody can go do it. And therefore, we have a lot of people in this business that are crooks. And some of them legally crooks. The ones that are selling annuities. You know, we have a new client recently, and was he probably in his 30s when he was sold an annuity?
If not his 20s. I think we had actually backdated it, and he was like 27 when he got put into an annuity.
That's crazy.
It is.
And we found out the lady that sold him the annuity is no longer allowed to practice.
Exactly. Yes.
Lost her license. So you just, it's such hard, you know, I have lost prospects, not so much in the last couple of years, but especially when I was just starting out, that said, well, we really like your concepts and what you're offering, but if we go with a big firm, then we feel like we have more protection if something bad were to happen. I mean, I guess they're alleging fraud or something like that, but in the end, Morgan Stanley is one of the biggest advisory firms or stock brokers out there.
Exactly.
And they're refusing to have any ownership in this. And so the victims of this Ponzi scheme are suing Morgan Stanley, but they're refusing to really cooperate in working with the victims. It did say further down in the article that there were a couple of victims that they had settled with. So my only guess is those victims are probably saying, that's not even my signature on the loan or something along those lines. Right.
Yeah.
But yeah, it's a real sad situation, and it is certainly avoidable. And it's avoidable by having checks and balances between TD Ameritrade and Schwab and Wiser Wealth Management. There's a wall. And then even when in cases where I'm a trustee for a family, there's still audits that happen on an annual basis, and those audit reports are turned over to the families. And so even when we ran private equity many years ago, those were audited, and audited reports were turned over. Every single penny is accounted for. So there's checks and balances that have to go into place, but you don't ever write a check directly to a financial advisor. That's dangerous.
Yes.
And illegal for the advisor to take.
No, exactly.
And on top of that,
it's all bad all around. And it's a wonder that it didn't get caught throughout the auditing process in some way, shape, or form.
Yeah, I guess the sneaky part was it was a Morgan Stanley loan product. And so once the money left, Morgan Stanley doesn't track where it goes. So in their defense, how are they supposed to know that it was all fraudulent?
Yeah.
Although they did interview one of I guess his coworkers, and they were like, his lifestyle didn't add up to the size of business he had.
Oh.
Saying he was taking all these worldwide trips.
Oh, interesting.
Really lavish trips, and he always wondered how he's able to do it, because because they probably made about the same amount of money, and there you go. That's how that happens. Okay, so let's hop into our list here. Surprise me. So we're gonna go with 5.
Yes.
And a lot of these you came up with these on your own. These are ones that you've seen with Missy as you guys do financial planning.
Yes, exactly. So these are the ones that we're seeing day in, day out. Clients, as we talk to them for consultations, or whether they're coming in for the entire financial planning process and we're walking through that with them, it ends up that a lot of these are the questions and the misconceptions that a lot of our clients have. And with our broad range of a client base, if we're having 4 or 5 clients with these same thoughts, then it's pretty widespread out there. And so the biggest one we've had here lately is people thinking that they're meeting their max on their 401k by matching their employer match, which is great. We love an employer match. It's great to make sure you're maximizing that benefit. And that's always your baseline, is you really want to meet that employer match. But that's not the maximum you can contribute to a 401k. And so that's been the crazy thing here lately that we're seeing a lot of people come in with, is they're like, yeah, I maxed out my 401k. And you're like, great, that's
right.
Phenomenal. We love that. And then we get to the design meeting when we're actually looking at the plan, and they're like, I don't contribute that much. And we're like, okay, let's go back then. And they're like, yeah, I matched the employer match. And we're like, okay, so you can actually contribute $22,500 for the 2023 year. And then if you're over 50, you can contribute an additional $7,500, bringing that up to $30,000 a year. So it is a great benefit to have. And we love to see those employer matches, but that's not the max you can contribute.
Yeah. I've seen that too over the years, is they max it out. And you always have to ask a clarifying question. Mm-hmm. But there are a lot of people who do actually max it out. So,
exactly.
So you kind of go through a string of those, and you think that you're on the same page. But sometimes with income, someone starting out making $50,000 a year is probably not maxing out their 401k at $22,500. But
exactly.
You never know. Okay, that's another good public service announcement.
Yes.
You can put more in than the match percentage. Yes. I have seen a few 401k plans that limit you to 50% of your income, but most of them do not. You can put in as much as you want to, as much money as you have in your paycheck.
No, definitely.
Up into the max.
Yes. So definitely a great benefit there, and to make sure that we're, encouraging our clients to contribute as much as they can to that benefit.
Okay. What's next?
Yeah. So next one is really going into your HSA. So another thing that employers are really on top of. And so that can not only just be used for your current medical expenses, but that's also a great retirement tool as well. And so that's one of those things where you actually have a maximum to contribute there of the $38.50 if you're an individual, or the $77.50 if you're with a family and contributing. And so that's a great spot to really be putting away retirement savings because we're just seeing healthcare expenses go skyrocket through the roof. So as those continue to increase, we really want to see clients use that more of a tool for retirement.
So the myth here is that if you have an HSA and you're contributing to it, you have to use that money. I guess they get confused probably with FSAs, flexible spending accounts, which are more focused on like PPOs or HMOs. So the idea is if you have plenty of cash flow, you would pay for that out of pocket. You allow the HSA to build. It's kind of like a Roth for healthcare. So it keeps building. And then once you hit retirement, you can use that HSA money towards your Medicare premiums.
Yes. Which is a great tool to have, especially, I mean, I think we have it right now projecting out and what we've seen with our Money Guide Pro software and just the statistics here lately is healthcare is growing at 4.5% on average a year for cost. And so that's just a major expense for anyone to be taking on if you're doing privatized healthcare in retirement.
Yeah. Actually, with the new model update inside our software, I think it's like 5.3 now. I saw that yesterday. So yeah, it's kind of running away from you. It's almost as bad as education expenses.
It is, yes.
Yeah, and for 20-year-olds, people in their 20s, when you do planning for them, their healthcare expense in the future is horrendous. It's a problem that has to get solved. But right now, as planners, all we can do is just plan for the worst, and hopefully that becomes spending money instead of medical money, right?
Exactly.
Okay.
And so our next thing, talking about high expenses, is renting is throwing your money away. As we all know, renting's going through the roof here lately.
That's an interesting comment. So explain, please.
Yes. So a lot of people feel like, and it's out there, and I've even been guilty of this thought of myself at different points of that renting, if you're renting, you're not building equity. And so you're just throwing your money away. There's no benefit to renting. And at the end of the day, especially right here and now for 20 somethings or even 30 somethings that are really living in this renting environment, and it's really a struggle to get into home ownership here lately, especially now with the interest rates being so high. It is something that it can feel like renting's throwing your money away, and that you're just kind of not building up your own equity. You're just giving it to the next person, and they're getting to get rich off of your rent. And so I think that's where people get kind of stuck in that rent cycle of, oh no, I'm stuck renting. But in reality, if that's the season of life you're in, then that's a great benefit. And to think you're not having those overhead household expenses that so many people don't even factor in when they're buying a house.
I don't think any young person probably does. We've had some conversations with some older people that are trying to buy way too much house for what they need. But, you figure, a refrigerator goes out today, that's like $3,500. And I guess if one goes out to your apartment, you're still replacing it. But roof, lawn care, caring for the house.
Exactly.
It's like if at my house, I have the not so good siding, but it's fine as long as you have it cleaned and caulked every year.
Gotcha.
Right?
Yeah.
And most people wouldn't do that. And so their house, the siding deteriorates, and then they have to spend $50,000 to re-side their entire house. Those are things that people don't think about. So I can see that. I mean, I would have a hard time, maybe this is the age difference between you and me, but I think I would have a hard time renting now, partially because I want to make sure that I have homes that are paid off by the time I retire. So there's a point at some time when you want to make that leap.
Exactly.
But what your point is that what you're thinking that people would change jobs, they wouldn't stay in the same location, or
yes.
Why is it better to rent now than it is to buy?
Yes. So I think right now you're seeing a lot of people are doing a different lifestyle, I think, especially in the 25 to 30 somethings. You're seeing a lot of people that are either working from home part of the time, and so they're traveling a lot, or it's even that they're even kind of doing the digital nomad lifestyle a little bit. Or it's one of those things too, where people are doing, I think loyalty is no longer as rewarded as it used to be in the workforce. And so I think you're seeing a lot of people that are jumping positions at different points. And so they're no longer staying in one place long. And I think that's part of, social media, I think too, is the grass always seems greener somewhere else, And so I think that's where you kind of have that, where a lot of people that are working at corporate firms or those kinds of things are like, well, I've been here 2 years. I'm going to go get my pay bump and move on somewhere else. And so I think that's where you have this almost unsettling spot where people aren't really settling down yet. And so I think if you're not in that settling down part of your lifestyle yet, then renting can be a great opportunity for you to just kind of keep living life and not have to take on those additional expenses, so that, when your, HVAC unit goes out, that's not on you.
Yeah.
That's on someone else. Or if the roof needs a repair, then you just call maintenance and they fix it for you. Or it's even if you're trying to, I think, save, I think that can be a great space to also kind of help if you're doing renting. Because I think the big thing is where you're seeing these huge skyrocketing rent prices really aren't in a majority of areas. I mean, that's your New York, that's your San Francisco, that's your like London, UK. Those are the places where you're really seeing these astronomical rent, and that's just because they don't have the housing for it anymore. And so I think that's where if you're living your day-to-day life in a normal city like Marietta, Georgia,
right,
you're really not struggling with that renting cost as much.
Okay. I think I might be able to buy that a little bit. I think what a takeaway is, I think for our older listeners, if your grandkids are renting, don't be ashamed.
Yes, exactly.
It's a little different time now.
Mm-hmm. Yes.
Because, the down payment on a house now is going to be at least $50,000.
Oh, definitely. And I know
and you're probably going to you're going to have to move pretty far north away from your job.
Yes.
Most likely.
Yeah. And I know it's very different, especially when I'm just even talking to my parents or grandparents. They're like, yeah, I bought a house as soon as I graduated high school. And it's like, how did you buy a house?
Right.
So it definitely is a different world and a different time. I know if you look at the statistics on housing prices, which is a whole nother conversation, it's astronomical compared to the growth in wages. So definitely different ball game than it used to be.
Yeah. That's part of the thing I think about, like legacy planning for families. So for families or ultra high net worth families is, that's another great place to have like seed money for the next generation. It could be seen as an entitlement possibly, but it's, when you think about families that have excess capital, so they have enough, plenty for them, and maybe they have brothers or sisters that have plenty for them, and they basically form like their own bank. So they have this pool of money that's put in equally by the family members, and you can borrow from things like that, right?
Exactly.
So that's another reason to keep building wealth and look for ways to help the next generation with it.
Yes. And while we're on renting, a huge thing that's come up in our client meetings is that rental properties are passive income, that you can just buy a rental property and all of a sudden you're going to be rich.
So
you're never
4?
going to have to work. Yes, in a way. Yes. Okay. It's kind of a sub point, I guess you could say more so. But that's another debunking, I guess, that has to take place in our client meetings, is helping them understand that rental properties are great and they are a great way to diversify your portfolio, but it is something that they're not purely passive income, like a lot of things make it seem.
No. No. Well, so there's the rental that you just buy and you put, someone rents it from you, they live full time and they sign a 1 year or 2 year lease, right? And then there's the vacation rentals, which require more work, but theoretically you could derive more revenue from the property and be able to use it yourself. But yes, what people don't take into account there is you usually get a loan, so you can get a mortgage, you buy the house, and then you rent it out, Well, it's cash free income, and CNBC is really guilty of this too. They talk about, oh, this young person built this $1 million company and drives 1 million revenue. Never tell you what the net is. You'd be moving $1 million worth of product, but what did that product cost to manufacture? And they never cover any of that. But the so anyway, you put money down, you buy the house, and you depreciate that house over 29 and a half years. So the good part is you have the depreciable value of the home. So that means any income you get probably is not going to overcome the depreciation in most cases. So it's really tax-free income. But then that income has to turn back around to pay for the note. So the interest becomes deductible. So it really ends up being a loss.
Yes.
But most people in this situation are not going to be able to claim the loss anywhere. So the loss just goes back to the basis of the home. The value of the home hopefully increases. So that's really what it's a long game.
Yes.
So the value of the home goes up. Someone else is paying the mortgage. It goes down. But you don't just buy a house and then you start collecting rent. Now, we do have a few clients who have done that. And they paid $2 million for a beautiful beach home and paid cash. And now it rents positive cash flow. But that's typically not how most people do it. But if you're in your late 30s, early 40s, that's really the time to start doing it, because you can get, they have this long runway to that by the time you hit retirement, that all that should be paid off. So it's not that it's a bad idea, but when something breaks or,
exactly,
it's work. It's work, especially, making sure that the home for vacation rentals, make sure the home is cleaned and ready to go for the next person. Not that I'm cleaning it, but you have to coordinate people. And what if they don't show up? Then what are you going to do?
Yes.
Right. So you kind of turn into a hotel of some sort for the short-term rentals. And then long-term rentals, I just worry, like, are they really caring for my home? Or if they leave, what am I going to find? If they stop paying, that's a whole process now that's very different than it was maybe 10 years ago.
Exactly.
But yeah, it's not a walk in the park, but it's not a bad idea, but you have to set your expectations. And I have worked with counseled very, very young people who think, I'm just going to buy a bunch of rental properties. Like, okay, you can do that, but it's not, you're not working a full-time job and doing that at the same time, most likely, when you own 10 of them.
No, it becomes its own job at that point. And so unless you're hiring, I guess, one of those management companies, then it helps.
Yes.
But then you're cutting into your bottom line.
Oh, as I say, you're giving up 30 to 40% of your revenue, gross revenue, which is even worse, for someone else to manage the property. Now, you can get away with that in, I think, larger properties that are renting out for $12,000, $13,000, $15,000 a week. But the smaller properties, it's harder because you have higher fixed costs that go along with that.
Yes.
Where those fixed costs in a larger home that has a bigger rental rate is not as noticeable on the bottom line. But yeah, I hear that all the time.
Yes, which hopefully when people are buying those houses and wanting to do rentals, the best long game, I feel like, in my opinion, would be to get a house somewhere that is where you potentially want to like live in retirement if you're wanting to do a move. Yeah. Because then it's fully paid for, and then you sell your house where you're currently living with your job and then move down to your beach house.
True. Or even think about this. What if you were a young person and you were renting in the city where you worked, but then when you bought your first house, you actually buy the vacation rental as your first house. Oh. And you rent that out. So you're paying that mortgage.
There you go.
But someone else is paying it.
Yeah.
So if
you want to do like a first-time home buyer loan on it too.
Is that, well, kinda. You got to convince them that you're going to live there. As a
That's true.
Residence.
Yeah, right. That didn't work.
But you might be able to swing it. Just don't tell the real estate agent or the closing people, and you might be able to swing that. I don't know. But yeah, so that's a lot of good advice there.
Yes. And then speaking of retirement, I think our last little note here is that your expenses decrease in retirement.
Yeah. I think it just depends. I'd say that we have a lot of clients who say, well, we have clients all across the spectrum. We have people that if they didn't have $250,000 a year, the sky's falling. And we have very nice people that live on about $35,000 to $40,000 a year that are as happy as can be. And so it just depends on what your lifestyle is, obviously.
Yes.
I think when you're not going back and forth to work, you're not being as tempted to make purchases or buy things that you do spend less in retirement. But for people who are, got to keep moving.
Yes.
Or have grandkids that they're spending more time with. Yeah, it definitely goes back up or stays the same at least.
Yes. No, and I think that's what we're seeing with a lot of clients when they come in. It's a lot of getting the realistic thought process on what your expenses are in retirement. So it's a lot of, we've had some clients lately that came in and they're like, we can live on $2,500 to $3,000 a month. And you're like, oh, okay, no, you make, $250,000. Like, let's be honest, that would not work.
Or sometimes people think, what do I need? And they only calculate their utilities.
Yes.
And some basic food. They don't ever, for some reason, they don't price in the lifestyle stuff.
Yes. And that's the part, the lifestyle part, as I believe what really goes up in retirement is that you're, hopefully you're, getting to take full advantage of your go-go years if you want to. And that's where a lot of our clients are wanting to do travel or, go and see the grandkids if they live far away and just those kinds of things, or even, get more involved in the community. And then that takes some of their money as well, or adds an additional expense to their lifestyle. So definitely something there of just making sure you're having the realistic mindset, because while your expenses probably do decrease in retirement, and we aren't necessarily debunking this myth, it is something that it's likely that your lifestyle expenses are going up.
Yeah. Yeah. Well, there's a saying that you have your go-go years, your slow-go years, and your no-go years. So it's going to definitely change. And then sometimes in our planning, what we can do is give a larger travel budget at the beginning. And then we back that off because you're probably not moving around as much, when you're 75 or 80 necessarily.
Exactly.
So we can plan for that in the cash flow of the plan. But yeah, I think it's honing in to what is it you're going to be doing and what is the real cost of that. And there are some people acknowledging that there are some people who their whole thing is to sit and do nothing,
Yes. Hey, after you've worked
and
that long,
these days.
that'd be nice. Maybe a year of that.
Right. Sitting and doing nothing. I feel like a lot of our pilot families tend to be more stationary, especially the pilots themselves, because they've been moving around so much, surprisingly, actually. Okay. Well, those are our 5 things that you and Missy and Michaela have
M&M team
have seen through our planning processes over the last year. We have some other things you can listen to. Episode 170, How Much Money Do You Need to Retire? Is a good episode for that. We also have some videos out there on our YouTube channel. It's called A Wiser Retirement. Is financial planning different than wealth management? And then are annuities a good retirement strategy? Those are also available in our show notes here. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click the link in the episode notes. Thanks, Michaela.
Thank you.
See you next time.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.